Coming up in today's show, stocks have a relief rally as yields pull back, jobs data comes in softer than expected, we'll take a look at whether the 10-year is going to hit 5%, some commentary from billionaires, oil drops 6% as demand pulls back, and Tesla rips higher on the back of its new Model Y. Hey everybody, hope you're doing well on this Wednesday. Welcome back to the Click Capital Daily Market Show. Stock market's certainly feeling a lot better today. After we got a bit of a pullback from those soaring yields, created quite the bullish rally across the board today, everything except energy on the back of crude oil, which took a bit of dive today. And stick with me because I'll get into that one on the charts a bit later. And of course it was mega cap tech that led the way today, with Tesla up almost 6%, which I'll get into that one a bit later as well. And so we're getting more of this yo-yo action back and forth from the jobs market. We just had JOLTS job openings yesterday, coming in a lot higher than expected, showing there's still plenty of work available out there. However, contrasting that was the ADP jobs data report we got today, and that's from the company Automatic Data Processing, which is based on private payrolls of about 25 million jobs, and it's a bit lower in terms of importance at a look of the labour market. Nonetheless, it came in a lot lower than expected, showing private sector employment only rose by 89,000 in September. That's the smallest increase in 2.5 years and a lot lower than what economists were expecting at a gain of 150,000 jobs. And that's probably what helped government bond yields have a little bit of a pullback from these elevated levels, because the more softening we see in the jobs market, the more likely the Fed can take their foot off the gas, and the closer we get to them officially announcing they're going on pause. And so that helped us get a little bit of a bump up in the stock market today. S&P 500 up 0.73%, with the Nasdaq continuing to hold this support zone and leading the way today up 1.36%. So it's the question on everyone's mind, will the 10-year Treasury yield hit 5% soon? And as usual, there's several large forces at play here in Treasury yields. First is the ever-present and dominant force, the Fed, as they have really strong influence on short-term rates. However, the market's been adjusting to that higher for longer sentiment for the last couple of weeks now. The second big and growing factor is we're getting a bit more of a spotlight on government debt, and the fact the US government has to refinance almost a third of it over the next year. And then a third factor is that now one can easily earn a risk-free rate above 5%. Something we haven't seen in many years. That could keep a lot of capital parked in those money market funds. And the higher yields go, the more money should flock there to get that easy yield. And that could help with some downside pressure on yields. And of course, the fourth factor is inflation, sticky inflation. And a big component of that is energy and crude. And so that drop in oil today probably helped yields pull back a bit as well. However, we've got one market veteran, Jim Bianco, saying the bond market is suffering from Old Testament capitulation and still isn't near the end of its route. He said bond investors have been getting their brains beaten and they can't take it anymore. He also said bonds are in a secular bear market with several more years to go. And if he's right, that would truly represent the most devastating period for bond investors in the roughly 200 years of US financial markets history. And that's because we've already got the drawdown in long-dated US Treasury bonds, now deeper than the drawdown we saw in stocks during the great financial crisis of 2008 going into early 2009. And that was a period of about a year when stock prices around the world, S&P 500, fell about 55%. And that's what the Vanguard Extended Duration Treasury ETF has already exceeded since it peaked out in August 2020. So this has been a very painful time for bond investors, as it's been a slow bleed lower and in terms of value loss as well. And we're actually on track for the third consecutive year of losses in the bond market, and that's something that's never occurred before in the last 200 years either. And there's a look at the clean monthly chart of that Vanguard Extended Duration ETF under the ticker symbol EDV. And it's actually trading at the lowest price ever since it came onto the market back in late 2007. So this has been a really rough time for bond investors over the last couple of years, and nobody knows for sure whether their end is near or not. However, we probably are closer to the end than the beginning. But the volatility we're seeing in bonds now is now equivalent to stocks. However, what I've been saying for a while now, I think the bottoming process in the bond market's going to be a long and messy one, because even when the Fed does announce they're on pause, we've still got a lot of bond issuance over the next couple of years to keep downside pressure on bond prices. And I'd say it's going to take the Fed cutting before we see a really good rally in bond prices, and that could still be over a year away. We've also got billionaire bond investor Jeffrey Gundlach saying it's time to start worrying about a recession in the US, as soaring bond yields signal that a downturn is coming. He said if unemployment rate ticks up just a couple of tenths, it will be a recession alert. And that's because we got the Treasury yield curve de-inverting very rapidly. And that's basically long-dated yields rising a lot faster than short-dated yields. And it's true, I'd be very surprised if we don't get a recession next year, because one of my own signals I follow for signs that a recession is close is the unemployment rate versus the 20-month moving average, as you can see in this yellow line here. And so last month it came in at 3.8%, and that's a bit above the 20-month moving average of unemployment at 3.61%. And you can see going back in history, whenever unemployment is reached really low, then curled back up above the 20-bar moving average, a recession is usually just around the corner, as we can see shaded in the grey on my chart here. And if I just zoom back in history, you can see we got that pattern in mid-2007. Unemployment rate went above its moving average, and then a few months later we got the recession. Same pattern in early 2001, and then just going back in history we see the same pattern over and over again. So here we are today, and it would truly be different this time if we didn't get a recession at some point over the next 6-9 months, because we still have all the ingredients for a recession there, as we can see in this table of recession risk indicators. Everything from housing permits to profit margins to credit spreads, the yield curve, are all indicating an impending recession. It's just jobless claims and truck shipments, the last two shoes to drop. And so whilst it's still technically possible that we get a miracle escape over the next year or so from a recession, it's still highly probable that we get one, and basically that means lower stock prices. And because of that inevitable recession and likely huge washout in the system, that's a big reason why I created this Only Bears strategy that focuses solely on shorting a basket of highly overvalued stocks. And so whilst the market is still up year to date, and barely done a 10% correction, my strategy is absolutely crushing the index, up over 40% year to date. And my goal for this strategy is by the time US stocks do get rinsed through a recession, that I can deliver between 200 to 300% total return to my subscribers of this strategy, which have currently already earned 48% since December, and who are pretty happy today after we just covered two shorts today. First being an Etsy, which we shorted back on the 27th of February, at $120 a share, earning almost 50% by covering at $63 a share at lunchtime today. And the second short we took back in early July, Marathon Digital Holdings. We shorted at $15.69 and earned a bit over 50% in that, as we covered at $7.51 today. And so this portfolio always holds 20 positions short. When we cover one, we immediately replace it with another. And if you're interested to know what two stocks I opened new short positions in today, then click the link below this video and head on over to my strategy page on the Collective 2 Marketplace, where you can learn more about it. And if you're interested, there's also a coupon code in the description giving you the first month free. And so if you run long-term portfolios with long positions, retirement accounts, like I do, then it can be a good idea to put a small allocation into a dedicated account and strategy like Only Bears that only short stocks, and that creates a great hedge for your overall wealth and family should the US stock market do a big crash and bear market over the next couple of years. Moving on, we've got another billionaire bond investor, Bill Gross, saying stocks are clearly overvalued, and he'd also avoid bonds as well. He said he doubts the Fed will be able to lower short-term rates anytime soon, and he said instead of bonds and stocks, the best bet is arbitrage and M&A activity. However, that's out of reach for most retail investors, as that's more of a sophisticated hedge fund strategy. However, I do agree with him that stock and bond returns are likely to be lower going forward than what we've been used to for the last 20 years. Here's a look at what some Wall Street strategists see the stock market headed after we had a tough September. And of course, FundStrat is still forever bullish, while JP Morgan has warned the carnage for stocks isn't over. Another one said soaring bond yields may just be a near-term headwind for stocks. One said October can be as difficult as September, but historically it transitions into a more hospital market environment. He said now that valuations are more attractive, and it's true October can be a month where we do see bottoms in the stock market. Another one saying this is just a corrective phase as markets adjust to higher rates. Others are saying the economy is slowing down, and of course Tom Lee is saying he's pretty confident we're going to have a nice rally into year end. And that's certainly possible. As we are in an oversold condition, we are likely to get a bounce. We'll just have to see how strong that bounce is, whether it can turn into a new rip and rally, or it's just a soft technical bounce back up to moving averages before it falls over again. However, if we're weak going into Christmas, that's really not a good sign for the stock market, as that's usually a bullish period. But like JP Morgan says, there's still good reason the stock market may not recover from its recent rout soon, as there's still some pretty big headwinds out there, namely the bond yields, and that valuations are still too high, and interest rates are now too restrictive. And something I and a few others have been noticing in this current market environment, and what's getting worse, is breadth. That's the amount of stocks hitting new lows and trending down underneath their moving averages. And so you can think of the stock market as kind of like the ocean and tides. And just as the moon has huge gravitational pull on the tides of our planet, you could think of interest rates like the moon, having a huge gravitational pull on stock valuations, amongst other things. And for there to be a healthy stock market rally, you really need to see the tide rise across the board, lifting all boats. But so far this year, we've had a skinny bull market led by the Magnificent 7 mega cap tech and just a few others. And so just looking at a clean weekly chart at equal weight. So this fund gives all 500 stocks an equal weighting in the index instead of the normal S&P 500, which has almost a third of its weighting just in those top 7 stocks. So looking at the equal weight gives you a better look at the whole market. And for those who are saying we're in a bull market, I'd have to disagree with that, because I know there's a lot of definitions of what a bull market is, 20% off the lows. However, I think a better definition myself is where the stock prices and equal weight indices have hit a new all-time high in the last 12 months. And as you can see in this chart here, the equal weight S&P 500 is actually lower today than where we were 2 years ago, and is in a sideways trend kangaroo market, up and down at best. And expanding to more breadth again in the Russell 2000 index, a really diversified index of smaller companies that derive more of their revenue onshore in the States, as opposed to mega cap tech from around the world. You can see that's down even more over the last 2 years, and at best you could call that a sideways market as well. Adding pressure to the downside in stocks are systematic trend following hedge funds, which largely follow momentum and trends in the market, and it's estimated they dumped roughly $40 billion in US stocks last week. That's the most rapid pace of CTA selling on record, and they've most likely been selling bonds as well, probably doing really well on that trade, as we've been getting some pretty good trends there. And typically trend following funds and strategies will outperform in times of stress and crisis, and that too can make for a good hedge for the typical long only portfolios most people hold. Also helping the drop in yields today is we've got a pretty good pullback in oil. As we've been expecting, that higher price in oil has been starting to affect demand from people filling up at the pump. And like I've been saying, Russia has now hinted that it may end its ban on diesel exports, and we may see the Saudis come out as well. As in my opinion, the Russians and the Saudis want oil around that $85 a barrel mark as kind of their sweet spot, where it doesn't hurt demand too much and competing clean energies don't become that much cheaper, relatively speaking. And we can see that pronounced move on the daily chart of crude oil futures. Did in the session on its lows on heavy volume, lost its 50-day VWAP, and because it has been on a tear the last 4 months, it's not really surprising to see it have a bit of a pullback, and we'll be looking for it to find support around this previous resistance zone, around $83 a barrel. Another news out today, Tesla launches its cheapest ever Model Y in the States, and that's the new rear wheel Model Y that replaces the all-wheel drive version that was discontinued in September. It has a 260-mile range, top speed of 135 miles, and the starting price is $43,990, which is $3,700 less than the all-wheel drive. And it also qualifies for that $7,500 federal EV tax credit, which brings the price down to $36,500, making it the cheapest Model Y we've seen in the States. And the market seemed to really like that, with Tesla a standout performer today, up almost 6%. And that was after we got that lower than expected deliveries number yesterday, showing they delivered 431,000 vehicles in the last quarter. That was versus 460,000 expected, but it was still roughly a 20% increase year over year. And so I think a lot of people forget Tesla is still growing at multiples of the other mega cap tech, bar NVDA, because other big stocks like Apple have actually showing contracting sales. Just quickly taking you over economic data we got out today. We can see retail sales in the EU actually contracted 2.1% year over year. And there's that ADP report coming in a lot lower than expected. Got that services PMI coming in just above 50 in a neutral zone, not really growing or contracting. And there's those gasoline stocks change coming in a lot higher than expected. And that's why we saw oil come off today. And basically that's people pulling back at the pump. So people are driving less and filling up less due to the high price we're all paying at the pump. Not much different in Fed Fund futures today. The market still thinks the Fed's going to be on hold for another 6 months or so. This market's still very nervous on shaky ground. We can see that in the fear and greed index. Still in the extreme fear zone at 19. And corporate insiders are just not buying this dip in the market. In fact, their sales are still outnumbering purchases 2-1. And pretty busy day in the options market. 40.1 million contracts traded. And a big difference in what we've been seeing most of this year, where people are just piling into calls every day. 56% of the volume today was actually in puts. And we can see that in that huge spike up in the put-call ratio, up to 1.63, which if that is a solid print, is the biggest one we've got in quite some time. And that's usually a contrarian signal. And that's one of the things my S&P 500 oscillator looks at as well. Looks at a lot of things underneath the hood of the market to determine whether we're oversold or overbought. And today that's currently sitting just above 35. And just like my dark pool percentage indicator, has the S&P 500 at 62%. That's pretty bullish as well. So the probabilities are we do get a bounce here. But like any indicator, they're not right 100% of the time. So you have to take them all with a grain of salt and keep that in mind. Everything's about probabilities, risk and reward. So the bottom could still fall out in this market and we get that big capitulation event, which could still easily happen because we've only got the VIX at 18.5. It did get above 20 this morning. However, the market normally bottoms when we get that spike on the VIX above 25.30. But looking at the S&P 500 and the equal weight S&P, which actually put in a hammer candle formation today in this support zone, I would say the probabilities are starting to weigh that we are near a short-term bottom and get that bounce soon. And like I said, we'll just have to wait to see how strong that bounce up, whether it just comes back up to the 50-day VWAP or it can go into a parabolic rip higher back to those July highs. Taking you out across the rest of the markets today was Canada's TSX, putting in a bottoming formation as well. There's the UK FTSE. German DAX put in a hammer candle, and China's 50 index, still the weakest of the bunch, actually lost that support zone yesterday and broke down a bit further today. And this market just seems to be constantly struggling to put in a good bottom. The Nikkei lost its support as well yesterday, but still being one of the better performing international markets this year. And the Aussie 200 trying to find support here on a hammer as well. We didn't get much of a bounce and breadth today. Still really low, only 10% of stocks above their 50-day average. And the amount of stocks making new lows versus new highs really doesn't bode well for the market. And we can see the stocks making new lows versus new highs at a really big ratio. And like I said, this can be contrarian that we're going to get a short-term bounce. However, it's damaging to the medium-term trend of the market when we do get this price action. There's growth versus defensive sectors still holding up, and growth stocks still holding up against value. Small caps continue to break down versus large caps. There's TLT trying to put in a bottom on the 4th consecutive reversal signal. Same with high yield bonds. Actually did a bit of a reversal candle today on huge volume. Dollar index is pretty much flat at 106.50, and Bitcoin still trading okay considering a strong dollar. That move in crude brought the whole commodity index quite a bit lower today, and already starting to approach oversold levels. And there's gold stalling out a bit, getting these reversal signals in the support zone, and we'll see whether we can hold here at 18.30 an ounce. Looking across stock sectors, pretty much green across the board. Still got the cannabis ETF having a bit of a pullback as the clown show in Washington continues. Hopefully they can get their house in order and pass some cannabis legislation and get this thing rocking again. Got a bit of a jump in Global Jets ETF today on the back of that fall in crude after they've been hammered the last couple of months as their biggest cost input in filling up their planes got more expensive. And there's the big pullback in energy and oil and gas stocks. After being the two best performing sectors these last couple of months, they now look to be getting already into technically oversold levels. And there's REITs putting in a hammer, and healthcare, staples, and utilities all looking to be stalling out, consolidating, and trying to put in these bottoming formations here. So the technical setup is there for a bounce, and we could get a big green candle any day now in utilities. There's the biggest asset manager in the world, BlackRock, trying to find lows as well. And JP Morgan, it's been the best performing bank, holding in there pretty good. Apple as well continues to try and hold this support zone around 172. And the other big guys, Microsoft, Google, and Amazon, all kind of just drifting softly. And over to meme stocks. Does anyone remember a bit over a month ago, the Vietnamese e-scooter maker VinFast briefly touching over 200 billion in market cap when it went over $90 a share? I was wanting to short it after that. There was just simply no shares available to borrow because it was just so obvious how overvalued and ridiculous it was. And of course, here we are 5 weeks later, down 90%. Looking out across the rest of the meme space, we did get some moves up, including a 9% bounce in EV maker Rivian. And just looking at a few other stocks we follow, there's Walgreens coming off a bit today, 1.1%. Sphere Entertainment up almost 2%. A little bit of a bounce in the cruise liners on the back of that oil drop. And another stock I'm short, Celsius, fell almost 3% today. And a little bit of a bounce in the regional banks, and the other big guys pretty much flat today, trying to put in bottoms here. Okay, so there we are on the S&P 500 at 42.63, sitting right on this big trend line here. The market is technically oversold. We're most likely to get a short-term bounce soon. However, that's not guaranteed because the elephant in the room, the government bond 10-year yield, even though it put in a bit of a shooting star inverted hammer formation today on these technically overbought levels, and we're most likely going to get a pullback in this soon. This could still easily go into a blow-off mode above 5%, as markets are quite often attracted to those big psychological levels, and that could still cause that mini flush-out capitulation event in the stock market. We get the VIX above 25.30, and then we set up for a good short-term bottom. But like I said, just looking at the weekly chart of the S&P 500, if we do get that flush, that'll just take us back into that sideways market, and we'll be looking for that big 4100 level to hold, as we've got a few turns there before. Then we may get the bounce going into Christmas. However, I say it's just setting up for more of this sideways market, which could still go on for years yet. We've been in it for the last 3 years, and we could be in for a decade of a kangaroo market, because I don't see rates going back down to below 1% anytime soon. And that pretty much wraps it up for today. Thanks very much for tuning into Click Capital and supporting this channel with your likes and comments. I really enjoy making these videos, and I hope to see you again tomorrow afternoon. Cheers.